Welcome to Premium Cashflow Real Estate Investing Podcast with SK099. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, SK099, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, SK099.
Welcome to another edition of Premium Cashflow Podcast. Today, I have the pleasure of welcoming Dan Schoenbaechler with Schoen Capital. Welcome to the show, Dan. I appreciate you taking time today.
Oh, thank you for having me. Happy to be here.
Thank you. So a little bit about Dan. Has been involved in residential sales and for the many years, and he turned into commercial real estate since 2013, and he has sold and brokered about $65 million worth of assets in a short time. He is also into multifamily, into 5 syndication deals worth $117 million, into just about 900 units right now, into 5 separate multifamily transactions. He is a big time capital raiser, has helped a lot of passive investors as well, based in New Jersey, and also helps out a lot of local investors around that area and has many passive investors. So we are here to kind of dig into your story, Dan. I appreciate you taking time today. With further ado, Dan, just give us some background about how you kind of got started and came into multifamily and things like that.
Sure. So I was born and raised in northern New Jersey, so about a half hour outside of New York City. So grew up in suburbia, lived in a single family house, ended up going to college out in the middle of Pennsylvania. Started as a business major, graduated criminal justice, thinking I would save the world with the FBI or the DEA, something like that. But I was really starting to get turned off by the curriculum towards the end, because I just had this desire of something more. And also I was in a band at the time, so I thought I'd be a rock star and touring the world. So I went home, tried a little solo album, got an entry-level job. And through the job, I realized that I think I wanted to be in sales. I was very fortunate that entry level is kind of a glorified customer service job. However, a lot of people undervalue what customer service is. I'm dealing with the warehouse and shipping and distribution. I'm dealing with finance to make sure the bills are paid or not paid. You kind of get to see how the whole company operates and interact with them. And I really liked the opportunity of sales with not only not being stuck in a cubicle all day, but going out, getting in front of customers. But it was a hardwood flooring distributor, and I didn't think that selling hardwood floors was what my calling was. So through some friends, ended up getting connected and going towards financial services. So I got licensed up, my Series 6, 63, Life and Health. And I was starting to help people grow their wealth through products like life insurance and mutual funds and whatnot. So I was enjoying that. It was quite a grind. And I also kind of intentionally jumped into that because when I was 18, I did read Rich Dad, Poor Dad, which is kind of the end all be all of real estate books. So it didn't sink in fully at that time, but I did walk away with a lot of the life lessons from it. So when I was coming into this stage of let's get my career going, one lesson I remembered was go for the hardest thing first. Take the biggest risk up front. You can always make up for it down the road. So I had heard that insurance sales is one of the harder jobs to be in. So started doing that. I was pounding out 100 calls a day and, just to get like one appointment a week, if that. So it was actually someone I was prospecting on the golf course about a year later. That was a commercial real estate broker. And he said, at the end of the round, I said, I think you need to diversify some of your retirement products. And he said, I think you need your real estate license. So he and his partner were working on a $140 million deal. And they were both just one-man brokerages, even though they did all their transactions together as a team, just for tax purposes and whatnot.
Sure.
And they've done over $1 billion in sales in 25, 30 years. So yeah, very good niche off-market kind of brokers. So I figured I could learn a lot. This gentleman, and this is what really hooked me. This gentleman said, I'll introduce you to my partner because he's got about 10 years left. I'm 62, 63. I'll probably be retiring in a year or two. And over the years, some of my clients asked if I wanted to invest, like roll my commission in or, add some additional money and get a piece of the property. So I have anywhere from 10 to 15% of about 6 buildings. And in a couple of years, when mortgages are paid down, I'll be passively making $400,000 a year.
Wow.
that is what I want. Free money showing up, like that's amazing. Let alone the concept of commercial brokerage, like hundreds of thousands a year. So, one sale and it's more than probably what my parents made 3 times over or something like that,
Sure.
So I had all the dreams of grandeur, gave my notice, stepped right into real estate school, got licensed. And then that was August 2008. By September, Lehman Brothers folded on my birthday weekend. And our deal pretty much died. We had an all-cash buyer within a couple million. We were negotiating, and they just walked at that point. And to this day, I think more than half the properties in the portfolio folded, sadly. And it just never came together. So here I am. I've worked my way down. With every job I got was less salary, to the point where I was at 0 salary, 100% commission. Commercial markets really just kind of froze. And residential was to follow. But I tried my hand at a couple different things. I got into energy consulting because Obama got in the office 2 months later. A lot of talk about green energy and stuff like that. I still actually do a little consulting with deregulated contracts. But I was doing that for a while and just trying to utilize my contacts. I had up till then, since beginning of high school, my summer job throughout college and what eventually supported me through the recession was caddying at a country club. So I was always surrounded by a lot of high net worth individuals. And at this point, I've watched their children grow. So,
Interesting.
Had really good relationships with a lot of people. And a lot of them would tell me, if you have, any opportunity, properties, I'm looking to invest. In fact, it was, I like to call it a little more of a blue collar kind of club because it wasn't, I'm the CEO of Goldman Sachs or Merrill Lynch. It's much more, I'm an attorney or I have an accounting firm. I do very well.
Sure. Business people who have, self businesses and everything, basically.
Exactly. And however, the ones that had the most money had built real estate portfolios on the side. So now I'm getting it from all ends. Real estate is the way to go. So, but they're asking for 7.5 caps. And in northern New Jersey, you're not going to find that except in a neighborhood you probably don't want to walk in at night.
Sure.
Just a much more Class D kind of neighborhood. And they're looking, of course, for a more turnkey, of very passive opportunity.
Sure.
So unfortunately, I didn't have a means to really close many people for that reason. I eventually decided to switch to residential because everyone had to live somewhere. And even though I moved back out of my apartment in Hoboken to go back with my parents, Hoboken is very expensive. It's right across the river from New York City, 10-minute commute. So even I think 10 years ago, I think the average household income was still about $130,000. So high net worth and people either had to pay a lot in rent or had condos they had to unload. So I figured, they're not commercial commissions, but if I do enough of them, I can live. And I'm doing real estate, which is making me happy. So that was a miserable year of 8 failed sales, including my first listing burning to the ground. Had a fire in the bodega downstairs and took up the whole building.
Oh boy.
So, yeah, that was like literally summed up my career up to that point. So I got into ad sales in the city. It was safe. It was a salary plus commission. So I'm doing sales, but at least I can afford my rent, feed myself. I have benefits. And then I was in transition where there was a downsizing and I got paid out all my severance commissions so I could breathe a little bit. And I, you know what, let me, while I'm sending resumes out, let me show up in my real estate office a little more, and hopefully I can bang out a few rentals, maybe get a sale lead. That would be great. And it was during that time that someone came to launch the first Keller Williams brokerage in town. And at that point, the people I was closest with in my office, which was a boutique mom and pop style, they became the top producers, and they were the first ones to leave and join the brokerage. And number one, I knew that I probably wanted to go for a bigger name, because I worked for a very big publication in ad sales. And when I said, "Hi, I'm Dan calling from such and such," they said, "Let me put you right through." But then when I moved to a smaller publication and said, "Hi, I'm Dan from such and such," you go, "Dan from where?" No, sure. Answer me. I have the perfect audience for you. You want to talk to me. Give me your money, please. So I did notice that brand had a little something to do with it too. Sure. So I figured if I'm going to try and restart this again, let me follow that. But on top of that, they were making a big push into the tech side. They were one of the largest, which now are the largest brokerage in North America, if not the world. And so there's a huge network of people around the country. Sure. And so I get multiple referrals a year just from being part of the country, part of the company. So I recognized that was very valuable. So fortunately, I didn't have to send any more resumes out because I ended up getting so busy that I was able to support myself doing real estate, because the training and education they offered has also been ranked number one multiple years in a row by Training Magazine. And it taught you how to run your business versus, oh, you have a license and you're breathing. Just come sit in the desk and talk to anyone that walks in the door. They taught you how to fish instead of being given a fish.
Sure.
So I was able to support myself. And, I had all this stuff I accumulated over the years. I knew what I had to do. I just didn't have the capital and means to do it. So, as soon as I got the chance, I ended up meeting my wife in Hoboken while living there. We briefly lived in an apartment together before we had an opportunity to pick up a 2-family. And it was because her parents were like, "I know that you're looking for a 2-family. Yes, we'd like to build a multifamily portfolio." So that was our jump, where we ended up buying it off them. And they made out fine, don't worry. And,
so how did that all, Dan, if I may, how did you kind of came into maybe perhaps your larger first multifamily? Let's go there perhaps.
Sure. So I'm doing all this brokering, and through a contact through Keller Williams, I end up meeting someone named Jason Yarusi. His wife was an agent with us. We did some business back and forth, and then she mentioned, "Oh, we do house flipping as one of our businesses." So I was showing him a few places in my neighborhood to flip, and one day he showed up and said, "Oh, I'm actually under contract on a 94-unit building in Kentucky." And I said, "How did you do that?" He said, "We syndicated it." I said, "Oh, what's that?" And then that's when he explained how it's essentially almost like a crowdfunding, a pooling of resources to acquire an asset larger than you could on your own. And he said the beauty of it is you can scale it very quickly. So while we have an accepted offer and we're not even closed yet, we're already looking for more properties. However, our network, we pretty much squeezed all the juice out of, and most of our friends and families invested in this. So we're going to need more capital. Sure. I said, well, I could probably help with that. I have 14 years of caddying for high net worth individuals. And even in the market that I service for brokering is also a lot of high net worth individuals that have some disposable income every year they could put towards an investment. So I already kind of had this database and the experience and knowledge of growing people's wealth. And now I'm a real estate guy that can provide real estate solutions for people in that regard. Because like I said, the people looking for the 7.5 cap or better, they don't want to manage that. And now I have another option to bring people when we can't find what they want, more passive option, which is ultimately what a lot of people want at the end of the day anyway, right?
Sure.
I don't think anyone wants to deal with tenants and toilets if they don't have to.
Right, right. No, that makes sense. That makes sense. Now, then talking to your passive investors and things like that, how do you educate them on, sort of multifamily or just, just the different various components of, how to evaluate a multifamily or what are the advantages? Like, how do you kind of interact with them or, educate them about it?
Sure. I always message the group that I'm available if they have any questions at any time. In the beginning, it was kind of a we have a deal, scrambling to get money to finance it, and so it's just kind of blasting out the investor summary, put a highlight reel, like this deal, you put in this much, it'll generate this much per year. Overall, it'll generate this much. And this is how long we're planning on holding it for. Let me know if you have any questions. So really, I was just kind of throwing them in the fire in the beginning, and they could come to me with specific questions. So I was getting a little one-on-one in the particular scenario. So we're all talking about one deal, but the good thing is that most of the deals I get involved in do tend to be structured relatively the same. There's kind of a base that we look for. If we're talking multifamily apartments,
sure.
Usually the goal, ideally, and depending, it'll sway a little bit, but usually we want to double your money over 5 years. And
Sure.
that between the distributions, the checks you get over the course of a year, usually quarterly, sometimes monthly, and then the big chunk of equity you get at the sale at the end.
Sure.
So all of that should double your money. So you put in $100,000, you might make 10% a year,
right,
on average. So that's your annual cash flow. So that's 50 grand over 5 years. And then we're hoping you get at least another 50 grand in
on
the
back
sale,
end when you sell. Sure.
and then the 100 you put in. So your 100 just turned into 200 at the end of the day. But the real nice thing about it, and especially because a lot of my database is fellow realtors,
I see.
People, as the IRS deems, real estate professionals.
Sure.
People doing over 750 hours a year, and a certain percentage of your primary income. So the tax reform in 2017-18 really put the advantage in our court. So, I mean, surprise, surprise, we currently have a president that made his living off real estate. So we were kind of expecting it. So the tax advantages that we can get on these deals are just insane because we're allowed to accelerate all our depreciation up front. And since we're holding short term, that's what we do. So,
sure.
A lot of people are getting over 50% of their, in a lot of cases, over 50% of what they invest.
Right.
Year one, they'll get more than half that to write off. I mean, every property varies, no guarantee on that, but we're going into it for the tax deductions too. And I know many people in the business legally paying $0 in federal income tax because of this. So
sure.
I'm not only increasing your wealth, you're getting tax advantages along the way.
Sure. Now, typically then, how do you sort of network with your other investors? What sort of means you use? I mean, you described you have your background from the golf industry. Are there any other ways, Dan, you go out and network with a lot more high net worth individuals and things like that?
Yeah, that's always the trick, to find them, right?
Sure.
Who's waving a checkbook that I can talk to? I am much more of a face-to-face kind of person. So COVID-19 has really taken me off my game.
Sure.
I'm getting a lot done and expanding my network. And thanks to podcasts like yours, that's been great exposure. What I really should be doing, and one of the big keys to this, is I should be creating my own platform, and I should be doing my own podcast and running my own meetup group. However, like I said, where I'm at right now, where brokering is still a big part of my life because it's my main income at the moment before these not passive for me, before all the syndication and commercial deals really start to add up. So I'll go to a ton of meetup groups. I was probably doing about 4 to 5 a month.
Nice.
In person, in various areas. And you get to know a lot of the usual suspects, and it's great because then people start introducing you to other people.
Sure.
So that's another thing that actually from my network, a lot of times they start asking me questions or something like that. I start pushing them to go to certain meetup groups like, hey, you should really come to this one. They have a guy talking about cost segregation.
Sure.
And that's how we get all our big depreciation write-offs. Come to this meetup Tuesday night. You'll learn more of what I'm talking about from the expert themselves.
Sure.
So I can kind of direct people to the sources and podcasts I enjoy, books. So I've kind of become a information center.
Sure.
Where people know, so cool, this sounds good, but where do I go? Like my one friend just unfortunately furloughed from his job, like a lot of people during this quarantine. And he said, I was only there a few years. I only have about this much in my 401k, which I need to roll over. And I said, have you thought of a self-directed IRA? Because that's enough to hit a minimum in a lot of syndications, and you could potentially invest in one of these deals. And that for the most part, it's not money out of your pocket. It's already set aside. You can't even touch it without getting penalized. So let's put it to work. So I have him looking at some materials and talking to a company about potentially doing that. So it was really a lot of self-education to learn these sources, because that's just how I run my broker business too. It's offering as much value as I can to people.
Sure. So now when a deal comes to you, Dan, what are some of the ways or some things you look at in a deal? Like, how do you kind of distinguish that, hey, this may be like a good deal, or perhaps this doesn't look as promising that you would want? What some of the ways kind of go into evaluating a deal like that?
Sure. And that's another niche of my business where I kind of become another layer of due diligence for investors. So I will evaluate both the operator and then I'll evaluate the deal. So mostly I'm only talking to mostly operators that I personally know, but you get the occasional Facebook or LinkedIn message, hey, I got deals. You want to help raise on this? And it's, okay, now I got to get to know the operator first. But I absolutely turn down way more deals than I get into. I think that first year I turned down about 8 deals for every one that I got into.
Wow.
7 or 8, yeah. So it's, I take the role of essentially being a custodian of funds very seriously. It's a very reputation-driven business. So when I see, let's say the operator's good. Then what I am looking for is, most of my database is now trained by seeing the same deals put in front of them, same typical structures. Hopefully we're roughly doubling the money over 5 years. Hopefully the cash on cash returns, what they're getting in their pocket every year, is somewhere in that 8 to 12% range, 8 to 10% range. And hopefully the internal rate of return is somewhere around 15% or more. So those are kind of some of the barriers that we're looking to pass. And then of course every deal is different. So if there's some sort of very interesting upside, then maybe we compromise a little on one number because it'll be in the end. Like such a heavy value add that the cash flow is low, but then the exit is going to be
a lot more. Sure.
That's worth it for some people. And some people say, I'm in it for cash flow. I got all the different people I'm talking to, all have different reasons to invest. So some I get almost nobody to invest, and then others are, how many checks can I write for you?
Sure. No, makes sense. I agree with you. I think every investor mindset is different. Some people like, like the stable deals. Some people just say, hey, I want, more sort of, let's say the appreciation, or at the, as you indicated, deep value add. So at the end, perhaps when you sell, there might be a lot more proceeds at the end, so those deals are, kind of the, what you call all the returns are deferred till everything gets sold at the end. So makes sense. So in a typical value add, Dan, what are some of the things are happening in your projects? Like, are you doing any exterior, interior renovations and things like that?
Yeah, a lot of times, like I said, there's different levels.
Sure.
Some could be such heavy laborsome jobs where you're ripping off all the roofs, maybe you have some foundational issues, stuff like that. I mean, for the most part, most of the stuff we're trying to get into since usually we're trying to hang around that 5-year exit timeline.
Sure.
We don't have time to redo all these buildings.
Mm-hmm.
But so usually it could range from a very light cosmetic, just update some of the interior, do a little landscaping. Then others could be much heavier value adds. So whether it's a heavy cosmetic, I mean, gutting full kitchens and bathrooms, trading out all the floors, mechanicals. It starts getting expensive and big when it's mechanicals, windows, roofs. So that's why certain stuff will narrow that down. So a lot of times in like the Midwest, we're looking for at least 1970s construction because the plumbing was different and usually troublesome pre-70s, as well as the chance of getting copper wiring versus non-copper wiring.
No, just a typical aluminum wiring.
Aluminum, thank you.
Right.
I wanted to say silver. I'm like, that's not right. Which we've done on one. We had a electrical wiring remediation on one property, and it worked in the numbers. That was well worth it. We got a heck of a deal, and so yeah, we'll do it. So it all varies on the level of construction.
Sure. Awesome. So now, Dan, as experienced as you are, what are some of the best advice you have received from, let's say, fellow investors or maybe people you have met over the years? What is some of the advice that have kind of stuck with you over time?
Oof, to narrow it down, that's tough.
You can give a few examples. That'd be fine too.
I've been very, very fortunate that this phase of my life, this business, I started with and have continually been surrounded by some great people. So I guess I would start there with surround yourself with great people and good mentors. Like any business, there's a lot of people, especially ones where you can really make big bucks. You're going to get a lot of shady people trying to make that quick buck, but it's not necessarily a quick money game. There's time that's involved, and you burn one deal, it could be the last deal. So definitely make sure it's quality people, someone you would want to take home to your parents and introduce to. Excuse me. And also track record. It's okay if someone's early on and light on the track record. If they have other previous job experience and history, like, again, I was a broker, selling real estate. I understand the ins and outs of a transaction and how markets work and analysis. Or other people have run previous businesses, so they dealt with accounting and management and things like that. So that can overcome the lack of direct real estate experience.
Sure.
But never stop learning either.
I agree with you.
I get a little annoyed sometimes that, I'll keep diving into all these books and podcasts and these resources. There's a lot of overlap because there's a certain degree where, okay, I covered this material and it doesn't seem like there's anything new, but just like in my brokerage company, we're known for our education and training. So I still go to as many classes as I can because there's always going to be one thing I didn't know. So read the whole book, go through the whole podcast, because there's going to be one tidbit or story. And then when that happens to you, you'll be prepared for it.
Awesome. That's awesome advice. Thank you, Dan. Please share with the listeners, Dan, how they can find you and connect and learn more about your company and your services.
Sure. Very active on Facebook under my name, Dan Schoenbaechler. LinkedIn, same thing. Website's still being built, which has been being built for a long time. But you can reach me at dan@schoencap.com. That's SCHOENCAP.com. And happy to talk to anyone, whether it's someone interested in becoming a passive investor or another operator. Open to it all.
Awesome. Thank you, Dan. Yeah, it's been a great show. Thank you for coming on and sharing your expert advice. It's been a pleasure.
My pleasure. Thank you.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.